$902,588. That number is not rounded, and I did not choose it. It falls out of the 2026 tax tables, and it marks a line almost nobody knows exists. Below it, a married couple retiring at 62 can move their entire retirement account from one kind to another over 8 years. They never pay more than 12% tax on a single dollar of it. Above it, some of that money is stranded. It gets taxed at 22% later, or it gets pulled out by force after 73 whether you want it or not. Same money, same couple. The difference is which side of that line the balance sits on and whether anyone told them the window was open. I'm Tom. This channel is about real personal finance, the kind that works for normal people, instead of the kind that sells you something. No motivational fluff, no fantasy returns, no get rich quick. Just what the math actually does over time. If that is what you want, hit subscribe. 2 kinds of retirement account run through everything that follows, so here they are in one sentence each. A traditional account holds money you have never paid tax on, so every dollar gets taxed on the way out. A Roth holds money you already paid tax on, so nothing in it is ever taxed again. Moving money from the first kind to the second is called a conversion. You pay the tax now, at today's rate, instead of later at whatever the rate turns out to be. Now, why a window exists at all? Because most people have never thought about their taxes this way. For your whole working life, your taxable income was decided by your employer. A salary arrived, taxes came out, and the only lever you had was how much you put into a retirement account. Then you stop working, and something changes that nobody tells you about. If you retire at 62 and delay Social Security until 70, there are 8 years where almost nothing arrives automatically. No salary, and no Social Security yet. Required withdrawals do not begin until 73. For those 8 years, you decide your own taxable income. You choose the number. That has never been true before, and it will never be true again. Now here is what makes it valuable. My neighbor Ron is 62, an operations manager who just retired. He and his wife have $900,000, all of it in a traditional pre-tax account. They need about $60,000 a year to live, which is probably not far from your own number. For a married couple in 2026, the standard deduction is $32,200. The 12% bracket then runs to $100,800 of taxable income. Add those together. A couple can take in $133,000 of gross income. Not $1 of it is taxed above 12%. Tax on exactly that much comes to about $11,600. That is an effective rate of 8.7% on $133,000 of income. Ron only needs $60,000 to live on. So every year he leaves $73,000 of the cheapest tax space in the code completely unused. And that space does not carry forward. It expires every December 31st, and a new one appears in January. Over 8 gap years, that is $584,000 of unused room. So here are Ron's 2 paths, and the gap between them is the whole video. Path 1 is what almost everybody does. He withdraws his $60,000 a year, pays almost no tax on it, and leaves the rest alone to grow. At 70, his traditional account still holds about $728,000. By 73, it is roughly $843,000. And at 73, the government starts telling him what to withdraw. The first required distribution is about $31,800. And it is taxable income whether he needs the money or not. That amount grows every year after, because the percentage they require rises as you age. Hold the balance flat for a moment just to see the shape of it. At 73, the required amount is about $32,000. By 75, it is $34,000, and by 80, $42,000. Reach 85 and it is $53,000. At 90, $69,000, and that is with the balance frozen, which it will not be. In reality, it keeps growing, so the required withdrawal grows faster than that. The government is not taking the money. It is forcing it onto your tax return in increasing amounts for the rest of your life. Path 2 uses the window. Ron still takes his $60,000 to live on. But every year, he also converts whatever is left of that 12% room, moving it from the traditional account into a Roth. That is roughly $73,000 a year, and it costs him about $8,760 in tax to do it. After 8 years, he has converted $580,000. Combined with the money he was living on, the traditional account is empty. Everything is now in the Roth. $728,000 of it, At 73, his required distribution is 0. Roth accounts have none. That money is never taxed again for him or for his wife. The total extra tax he paid across those 8 years was about $69,600. Now, the reason $902,000 is the specific number. Run that same 8-year sequence on different starting balances and watch where it stops working. At $700,000, the traditional account empties in year 7 with room to spare. $900,000 empties right at the end of year 8. Start with $1,001,000 and about $200,000 is still sitting there when Social Security arrives and the window closes. $902,588 is where the account runs out at the exact moment the window does. Any larger and something gets left behind? That is not a rule somebody invented. It is where the 2026 tax brackets, the standard deduction, a normal retirement spending level, and an 8-year gap happen to intersect. Which means your number is not Ron's number, and the thing that moves it is not what you spend. That surprised me when I ran it. Your living withdrawals and your conversions come out of the same 12% ceiling, so spending less does not give you more total room. It only changes how much of the ceiling is conversion instead of living expenses. What actually moves your line is how many years you have. A 2-year window puts the line at about $260,000. 3 years, $380,000. 5 years, $605,000. 8 years, $902,000. 11 years, if you retire at 62 and somehow stretch it all the way to 73, about $1.16 million. So the line is really a function of one thing, how early you stopped working. One thing changes this substantially, and it is worth saying because half the people watching are in it. Everything above is a married couple. A single filer has a standard deduction of $16,100 and a 12% bracket topping out at $50,400. Add them and the ceiling is about $66,500, exactly half the couple's. A single retiree spending $45,000 a year has about $21,500 of annual conversion room. A couple spending $60,000 has $73,000. The couple has more than 3 times the room and their line sits far higher. A single person with the same $900,000 simply cannot clear it at 12%, no matter how long the window is. That is not a reason to skip the strategy. It is a reason to know that your version of it is partial rather than complete, and to decide which dollars are worth moving. But first, the objection that should be forming right now: Ron paid $69,000 in tax he did not have to pay. He could have paid nothing for 8 years. Why would anyone volunteer for that? Because the alternative is not paying nothing. It is paying later at a rate you do not control. Run the comparison. Ron converted $580,000 at 12%. Say that money had come out at 22% instead, which is the next bracket up. The tax on it would have been $58,000 higher. At 24%, about $70,000 higher. So the $69,000 he paid was not a cost. It was a purchase, and what he bought was certainty about the rate. And there is a second thing he bought that is easier to miss. When one spouse dies, the survivor files as a single person. The standard deduction is cut roughly in half, and the brackets narrow dramatically. A widow with the same income her household had before pays substantially more tax on it. And she does it in the year she is least equipped to deal with paperwork. A traditional account with $800,000 in it walks straight into that. A Roth does not. There is a third thing Ron bought, and it has nothing to do with him at all. Since the SE Sure Act, most people who inherit a retirement account from someone other than a spouse have to empty it within 10 years. Say Ron's children inherit $843,000 in a traditional account. That is roughly $84,000 a year of extra taxable income landing on them for a decade. And it lands during their peak earning years, stacked on top of their own salaries. An heir in the 22% bracket pays about $185,000 in tax on that inheritance. At 32%, closer to $270,000. The same money in a Roth still has to come out in 10 years, but every dollar of it is tax-free. So the conversion moved the tax bill from a child earning a salary at 32% to a retiree at 12%. That is the same dollars, taxed at less than half the rate, purely because of when they moved. There are 4 situations where this is the wrong move. This strategy gets sold far more often than it gets stress tested. The first is the one that decides it. Converting only wins if your future tax rate is higher than 12%. Run the numbers both ways. If Ron's future rate turns out to be 22%, converting saved him about $58,000. At 24%, about $70,000. But if his future rate turns out to be 10%, converting cost him about $11,600. He paid 12 to avoid 10, and there are plenty of households where 10 or 12% really is the permanent rate. A couple living on Social Security plus a modest portfolio may never leave the 12% bracket at any point in there. Retirement. For them, this entire strategy does nothing except move money and generate a tax bill. So the first question is not, how do I convert? It is whether your future rate is genuinely going to be higher than your current one. If the honest answer is no, stop here. The second problem is where the tax money comes from. Converting $73,000 costs about $8,760 in tax. If Ron pays that from a savings account, the full $73,000 lands in the Roth. If he pays it out of the IRA itself, only about $64,000 lands there. He converted 73 and sheltered 88% of it. The strategy is meaningfully weaker without cash on the side to cover the bill. If every dollar you have is inside their retirement account, the arithmetic gets thinner every year. The third problem catches people who retire before 65, and it is expensive. If you are buying health insurance through the marketplace before Medicare starts, your premium subsidies are calculated from your income. A large conversion raises that income. So somebody retiring at 62 with marketplace coverage can convert aggressively and feel clever about the tax brackets. Then they lose thousands of dollars in health insurance subsidies in the same year. Those are exactly the years, 62 to 64, that this strategy wants you to use hardest. For anyone not yet on Medicare, the window is narrower than it looks. The fourth is Medicare's own income surcharge, and it has a strange shape worth understanding. Once you are on Medicare, an income above $218,000 for a couple triggers a surcharge on your premiums. In 2026, that starts at about $81 a month per person and climbs from there. But the surcharge is calculated from your income 2 years earlier. Your 2026 premium is set by what you earned in 2024. Medicare starts at 65. So the first year a surcharge can appear as age 65, and it is driven by your income at 63. So conversions at 62 and 63 are the last ones completely outside its reach. That is a real reason to front load, and almost nobody sequences it that way. For an account the size of Ron's, though, the surcharge is not the binding constraint. His 12% ceiling is $133,000. The surcharge does not start until $218,000. He rents out of cheap bracket long before he gets anywhere near it. The surcharge only matters if you convert aggressively into the 22 and 24% brackets. That is a different strategy with a different answer. Now what happens if your balance is above the line? Say you have $1.4 million in a pre-tax account. The 8-year window at 12% will not empty it. You have to decide how much you are willing to pay. Filling the 12% bracket costs 12% on the converted amount. Pushing all the way to the Medicare surcharge threshold means converting about $158,000 in a year. The blended rate on that is about 17%. 17% is not 12, but it is also not 22. And it is certainly not the rate a surviving spouse pays on a forced withdrawal at 75. There is no clean answer above the line. There is only a choice about which rate you would rather pay, made with information instead of by default. What I want you to avoid is the third option, which is what most people pick. That is doing nothing. Letting the account compound untouched and discovering at 73 that the government has become your withdrawal planner. So here is how to find your own number, and it takes about 10 minutes. First, count your window. It runs from the year you stop working to the year Social Security starts, and it ends no later than 73. For Ron, that was 8 years. For somebody retiring at 65 and claiming at 67, it is 2. Second, find your ceiling. For a married couple in 2026, gross income up to $133,000 stays inside the 12% bracket. For a single filer, it is about $66,500. Third, subtract what you actually need to live on. Whatever is left is your annual conversion room. Fourth, multiply that room by the number of years in your window. That is the total amount you could move at 12%. Compare that total to your pre-tax balance. If your balance is smaller, you can clear the whole thing at the cheapest rate you will ever see. If it is larger, you now know exactly how much will be stranded, and you can decide what to do about it on purpose. One more thing about the timing, because it is the part people get wrong even when they understand everything else. This window opens the day you stop working and starts closing immediately. Every year you spend deciding is a year of room that expired. $73,000 of unused 12% space cost about $7,300 in extra tax. That is what happens when the same money comes out at 22% later. That is what 1 year of hesitation costs. Not a rounding error. And it happens quietly every December to people who fully intended to look into it. Ron's balance was under the line, which is why his story ends cleanly. Most people never find out which side of it they were on because nobody ever told them the line was there. Your pre-tax balance is a number you already know. The window is something you can count on your fingers. The ceiling is published by the IRS. Those 3 numbers decide whether the largest account you own gets taxed at 12%. The alternative is whatever the rate happens to be 20 years from now. In a year you did not choose, on an amount somebody else calculated. If this was worth your time, hit subscribe. I will see you in the next one.